On today's Hot Sheet, I'm discussing the latest PCE inflation data from the end of last week, housing inventory, and pending home sale data. Today is Monday, June 2nd, 2025. I'm Byron Lazine, and the Hot Sheet starts now. Okay, live from my Connecticut office and studio of Haley here with me today for this Hot Sheet. Let me know in the live chat which market you are tuning in from, wherever you may be. Let's get into it here this week. We're now a full week plus into this true summer season. It is summer. I know some people wait till what, June 20th, 21st, something like that. I
Oh,
think
yeah.
the official date on the calendar is later, but like Memorial Days happen. It's summer. Didn't feel like it yesterday up here in Connecticut, but certainly starting to feel like it today. And the market is starting to feel like it. And when we get through inventory today, I've got a big prediction. Okay. I don't like to make a lot of predictions when it comes to housing data. Lance Lambert and Logan, they would tell, don't make predictions, make model. I'm just going to make a big prediction. We'll see where it ends up. I've been lucky on some of my predictions, but the housing inventory tells me something about how this summer might roll. Okay. And we're certainly there. All right. Let's first start with some of the macro data that's going on here. And before we get to the PCE that wrapped up last week, we got some news here happening today, which we'll keep an eye on. Impact of what's going to happen with, the stock market's down right now to open up the week. The 10-year kind of ticking up a little bit, but it had come down over the weekend. This is based on some conflict now, waking up with conflict. It's always an up and down day. Every day is a little bit different as we look at the macro dynamics of the economy and how politics and DC are impacting that. The conflict between US and China is kind of heating back up. Okay. So China's pushing back saying, hey, we're not getting a great deal here. They had an agreement. Remember in Geneva just recently, they had an agreement. The markets responded well towards that Geneva agreement between the US and China. And the Trump administration has since increased tech export restrictions. They've put pressure on Chinese student visas because of these items, and other tensions have once again risen. And this is a little bit even beyond trade. Some of this stuff is going to be more political. So we're looking now at a trade war amongst other disagreements between these two, major trade partners that is having an impact globally. Okay. When we look at where the 10-year is starting off, just based on this news, again, stocks are down. 10 years slightly up, 4.438. If we look at the last 90 days, that's still hovering. While it's down a little bit over, say a week's time frame, that's still hovering around the highest levels we've seen in the last 90 days. So relief on rates, long-term treasury rates isn't here. Okay. If you look at 3-month T-bills, Warren Buffett all of a sudden is the biggest holder on 3-month T-bill. You can get a really good deal on 3-month T-bills. Okay. Compared to, why would you want 10 or 30-year treasury bills when you can get a 3-month at, almost the same percent. So Buffett now holds 5%, stocking up on this short-term treasury bills for the US, while the 10-year, the 30-year hasn't been as attractive. These auctions for the treasury bills have not been well attended. Okay. So that's going to keep that number inflated. Like, if you want me to take your 10-year, your long-term debt, I need a bigger number. Okay. Remember, when you buy a treasury bill, that money that you loan to the US government goes right into their bank account. So if I'm going to lend this money, I'll need a greater return. That's what the market is saying to America right now, and it's keeping those rates high. Unless you get a labor break, you're not going to get help on that. The only two I mean, maybe inflation getting down to the target level, but I think even then it'd be hard to say, oh, they're just going to start cutting rates. You need to have some concern on labor. As we look at inflation from the report from last week, the PCE report that this is the Fed's preferred reserve rate that they look at. This is the PCE is the one that they like. Okay, so April's PCE preferred inflation gauge for the Fed. It actually revealed good news: deceleration in headline inflation to 2.1% annually. They're looking for 2%. Okay, it's the lowest print for the year so far. Core PCE now has also eased. That goes down to 2.5% from a revised 2.7 in March. So there is a continued disinflation trend that's happening. This is according to Jamie Cox, who's the managing partner for the Harris Financial Group. This PCE report, he says, confirms continued disinflation, despite the refrain from everyone that disinflation isn't possible in this environment. As Alan Greenspan would have said, it's a conundrum. Okay, so people, there's a lot of fear. Oh, inflation is going to go up. The tariffs. You talked about the tension between two major trade partners, U.S. and China, and you're seeing the opposite. You're seeing inflation continue to move down. I know Jamie Dimon wants to talk about stagflation being something that we should be considering. But that we're not there, and the hard data tells us, hey, inflation is continuing to move in the right direction. We're certainly seeing that with shelter. Okay. And when shelter catches up on CPI, I think those numbers are going to look even better. And this is something we've been saying. We want Jerome Powell. I mean, I would be on the side if I want Jerome Powell and the Fed to be on the early side, not the late side again. I know that's one thing the administration is pushing for. Doesn't look like, according to CME Group, that's going to be the road or the path that the FOMC takes when they meet 16 days from today. 98.7% that they do nothing. Once again, they keep the rate in that 4.25 to 4.50 range. A little bit more news on the PCE, just to take a look at personal income increase, 210 plus billion. It's a 0.8% monthly rate for April, according to this U.S. Bureau of Economic Analysis, came out on Friday. DPI increased to 189 billion. It's 0.8% personal. And then the PCE, of course, on the 0.2%, best PCE report we've had on the year. The sum of PCE, personal interest payments, personal current transfer payments increased 48.6 billion in April. Personal savings was 1.12 trillion in April, and the personal saving rate as a percentage of disposable personal income was 4.9%. Okay. So there you go on some of that. Here's the changes in monthly consumer spending as it looked in April. Services, housing and utilities, 24.7 billion. You saw goods go up 8.1, gas and energy. Some of the things that moved down: recreational goods and vehicles, clothing and footwear, motor vehicles and parts. So cars overall moving down. Saw a lot of good lease deals over the weekend. Was looking at some cars. People aren't looking. I'm looking all of a sudden. People aren't looking at homes. That's when you should be looking at homes. Okay. Tesla's got some good deals. Financial services and insurance, 4.6 down. And so there you go. There's your PCE report. Overall news is PCE on the overall going into the right direction. PCE and PCE, excluding food and energy, both moving down. Best print on the year. So inflation seeing disinflation right now. Okay. Let's get into the inventory for the week. We look at this been looking at this every week for the last 3 years. I mean, as long as we've been doing the hot sheet, we look at it. Inventory for the week, is it going into a more normalized place? And by the end of this year, across the country, we are going to be able to say we're at pre-pandemic levels. I mean, that's just where this thing is heading. That's not a guarantee. That's my big major prediction. We're going to get to the beginning of this fall and we're going to say, listen, on the macro level, on the national level, we are a lot more similar to 2019 than any other year in between as it relates to single family inventory. National single family inventory for the week jumped up again, another big number, 16K plus on the last week. Okay. Same week last year, we were at 604,000. We only jumped up 10,000. We jumped up 16K versus 10K for the same week. We were at 604,000 on national single family inventory same week last year. We're already at 803,000. Our peak last year, remember, was 739,000. We're already 60,000 above that, and that peak came in October. Okay? The World Series is a long ways away. We haven't even had the All-Star break yet. The October baseball, playoffs, World Series, that's when we peaked out on single-family inventory last year. If we follow that same trend, wow, we got a lot of hot dogs, a lot of peanuts in our future before we peak out on national single-family inventory. Like, there's just a lot. It's the second day in June. You got June, July, August, September. You got 4 months if we follow the same trend of last year. I mean, this is where we were last year. And what we did between here and October was just continue to climb up on single family inventory. We see that same, 4-month climb from where we're at right now. We may actually pass. I don't know if we'll get past 2019 levels. Maybe on the backside of the fall, we could. I think we could. But we're going to be into the 900,000s on single family inventory in the fall. Like, we're going to get there. I mean, we may get there before the end of the summer. And we may be there before Labor Day. Okay, nobody really knows how much inventory is really going to come on in terms of new inventory. One thing that's going to be interesting as we get closer to these 2019 levels, with 33% more than last year right now, as we get closer to 2019 levels, we're really going to understand what's behind this pent-up demand. What's really back there? The options are out here. How many buyers have said, like, hey, over the last couple of years, I'm discouraged, can't find what I'm looking for? Well, you're going to have a lot of options. And if those options don't bring that demand, I think interest rate's going to bring more of the demand out. But if the inventory doesn't bring the demand that we say is pent up, I think it's only pent up 3 to 5 million homes short of supply. I think it's only pent up in certain price ranges. I think it's silly to say if you dump 4 million homes into this market and they're not at a particular price range, that they're going to do anything other than jack up months of inventory. And so it'll be telling this summer how much pent-up demand is there based on inventory. I think it's all based on rate. I think it's all based on price. And so if that's the case and these DOMs start ticking higher, you're going to see pressure on price that you haven't seen. And I get it. Southwest Florida is saying we're seeing it. Austin, Texas said we've been seeing it for 3 years. Tampa's seeing it. Gotcha. Those locations, you'll see even more. Okay? There's some locations, there's a bifurcation going on. You're not going to see it everywhere. But it'll be really telling this summer as some buyers just fade away out of the market because they want to enjoy the summer. Nothing better than high noons and all beef dogs. Like, that's what some buyers want to do, and they want to exit out of the market. Well, I would argue that's the time you want to be in it. I want to be shopping when there's less demand and there's more inventory coming every single day. but we're gonna learn a lot over the next 90 to 100 days. Listen, I'm not Darth Vader on X. I'm not Nick Girelli, who lives in a crappy apartment somewhere in Texas, who's been calling a housing crash for the last 5 years. Okay. I'm saying pressure on price means the realistic sellers got to think tomorrow, not yesterday. That's what I'm saying. Okay. I'm not calling for 20% collapses or any, don't go buying gold and crypto after this show. Okay. I'm saying downward pressure on price. We're going to learn a lot about the market in the next 90 to 120 days. All right. New listing single family, still improving. We get into that 80,000 plus category. We're really going to start jacking this number up. We were at 70,000 for the last week, 63,000 for the same week the year prior. So that number continues to improve. Expect this number to move up, not down the rest of the summer. Percent of properties with recent price reductions were higher than we were any level the last 3 years. And I expect us to continue to stay higher as this inventory builds up at levels we haven't seen in the last 3-4 years, and even beyond that. So 38% on the price cut percentage. Typically about a third of properties will cut price before in any given year before they sell. We're above that. Okay. So that's another sign. Hey, what's really behind pent up demand? What's really back there? We're going to talk about pending sales from the NAR perspective here in just a minute. But according to Altos Research, weekly pendings came in at 72,000. That's versus a 62K same week last year. So, hey, closings are taking longer to happen. We're not seeing a lot of this data really show up in closings, but we are seeing more pendings. Hey, when you've got more options to buy, or get out of a deal, go into another deal, or keep extending and work the negotiation, work the inspection. When you have more options, you can just massage sellers a little bit longer. Okay. You don't have to, get closed up in 3 weeks, might be 3 months. So closings are happening longer. So the pending sales, while better, aren't really reflecting in some of the closings. According to Altos, we're above last year. Total pending home sales, 413,000 homes in contract, single family. It's better than the last 2 years. So seeing some signs of stabilization, at least on pendings, but the closings again taking a while for them to show up there. I mean, really 4 million existing home sales. That's bottom of the barrel. That's floor level stuff. Mortgage app index, 17 straight weeks of positive year over year data. That's the big one that does give you, hey, some future is bright hope. If you get those rates down to 6%, that's where you can see a market shift. That's where the pressure on price to the downside kind of alleviates, and you start really seeing a more fluid market. You see closings moving up. 10 positive readings for the year, week over week, 7 negative, 3 flat, but 17 when you go year over year, 17 straight weeks of positive data. So feel good about the second half of the year. Okay. Again, you don't got to go buy crypto. You don't got to go buy gold. You can kind of sit and wait. Okay. So, this market, you're not going to go out of business in the second half of this year if you're doing the right things. So, these are the signs that tell me and help me believe that to be the case. All right. Spread on the 30-year rate, getting back to last year's levels, of course, kind of covered that a little bit earlier here on what's going on with those rates. Our debt's pretty unattractive, and that's where we're at. All right. Pending home sales April report. Just showed you Altos for where we're at on the year and on the week. NAR puts out their final report here for April. And April, we had from March to April, we had pending home sales that moved down 6.3%. Okay. Now, Altos has more real-time data, so we'll see if NAR catches up with their data as we move forward in these months ahead, right? May looked really good according to Altos, put us over a year-over-year mark, and so did the weekly. So the last 5-6 weeks, according to Altos, trending better here than this NAR data. But as we look at April, pending home sales were down. Supposed to be the, kind of the the Super Bowl of months for home buyer demand, and it wasn't that from March to April. The South moved down to an 85.9 on the index. The index is, coincides with 100, coinciding with a higher level of activity relative to 2001. So, you want to see kind of a 100 across the board. If you had the demand and the, that's when you get to like 5.5, 6 million, transactions, at least over 5 on existing home sales. 85.9 for the South, moves down 7.7% for the month of April. You come in next on Midwest, 73.5. They moved down 5% month over month, March to April. Northeast coming in at 62.1, moved down slightly March to April at 0.6% for the month. And then the West at 53.3, moved down 9% month over month. America across the country comes in at 71.3 on the index. Again, the month over month move down was 66, or it was down 6.3. That is okay. Again, starting the week here at 10 years, 4.438. 30-year fix ended the week last week at 6.95. The weekly came in at 6.89. So we're kind of been stuck here for a few weeks in the high 6.9 range and the low 7 range. That's the reality. No indications here as we kick off this week with what's going on economically that there's any reason to believe that this number moves down anytime soon. Remember, the summer, it's not just slow on demand in real estate. You start to get the stock market, they kind of like to put those algorithms on autopilot. I feel like as you get closer to August, everybody goes on their yacht, put the algos on autopilot, and just make sure nobody loses a whole bunch of money. So we're getting into that time of year. It's all about, what do they say across the pond? Holidays. Everybody wants to be on holiday. Expect that to have an impact on all markets moving forward. We're dealing with a lot of volatility. So obviously anything is certainly possible there. This week, tomorrow we'll have a live role play for members before the hot sheet. So 9 a.m. East Coast time tomorrow, inside of the community for BAMX on School. We've got the live role play tomorrow. So that'll be myself, Tom Toole, Lisa Chinati. These have been really well received, working through some of the scripting that we need in today's market. That's tomorrow, 9 a.m. Just check for members. Just check your school calendar. We've got an office hours this week with all the content, the content audits and template Q&A happening on Wednesday. Then a public webinar. Haley, you can drop the link to this for everybody. Public webinar that I'm doing with Burton from PropStream. I've got 3 killer scripts on seller lead sources. So Burton's going to show me how to pull the data for these scripts, and then I'm going to deliver the scripts. It's a public webinar Wednesday noon Eastern. Also for members, your hot sheet classroom here fully stocked up now for June, kicking off June every single day. All the charts, templates that I use, or charts rather, that I use right here on the hot sheet. There's all of today's available for you. May's are up, April's are up, quarter one's all grouped together. When you go back into the classroom, you get your new content from Friday each and every single week. So last week's content drop, both the hyper local trends as well as some of the stuff that's happening macro, all available for BAMX members. Go to school.com/BAMX to jump into that if you don't have access for that yet. All right, that's what's coming up this week. I'll see those of you attending the role play members tomorrow at 9, and then we'll be back here on the hot sheet at 9:30. Until then, of course, toodaloo.